As an experienced stock investor and storyteller, I want us to impartially unpack the conflicting bull and bear narratives surrounding Nvidia's historic 2026 valuation. I mean, we're staring at a company that recently breached a $4 trillion and even a $5 trillion market cap. But the ultimate question on literally every investor's mind right now is, where does it actually go from here?
75%. Just let that staggering figure sink in for a second. That represents Nvidia's projected Q4 fiscal 2026 gross margin. Maintaining a mid-70s gross margin at this massive global scale is almost unheard of in hardware, and honestly, it serves as the undeniable catalyst for today's deep dive. Can this stock actually keep defying financial gravity, or is a reversion to the mean just inevitable? To evaluate the potential upside over the next decade, we're going to structure our analysis by looking at the new AI economy, the generational technological leap, those super aggressive 2026 to 2028 bull projections, the cautious bear market warning, and finally, a synthesis of the valuation.
Starting things off with Section 1, the new AI economy. This is where we really have to anchor our analysis in Nvidia's undeniable recent financials. The scale here is just absolutely breathtaking. Nvidia just posted a blowout $68 billion in Q4 fiscal 2026 revenue. That is up an incredible 73% year-over-year. Plus, they're guiding Q1 to $78 billion. This kind of flawless operational execution has secured them a phenomenal market capitalization of over $4.19 trillion. They are, for all intents and purposes, the backbone of the modern AI infrastructure.
And you can really see the stock's massive price hikes through 2024, 2025, and right into 2026. It's returned over 650% in just 3 years, compared to the S&P 500's 38% gain. But, as an experienced investor, I always try to step back. We have to compare this near vertical ascent to another tech monopoly, Google. Despite Google's absolute dominance over the last decade, its stock has sometimes fallen sharply over the past 5 years due to market rotations, regulatory fears, or just shifting ad markets. No stock goes up in a straight line forever, right? Which is exactly why we need to deeply analyze Nvidia's structural foundation.
Which brings us to our next section, engineering the generational leap. We need to understand the foundational thesis that's actually driving these massive numbers.
So the absolutely crucial point here is summarized perfectly by CEO Jensen Huang. He argues that for hyperscalers, the Amazons, Microsofts, and Googles of the world, spending on Nvidia chips is no longer just a discretionary cost center. Instead, it's a direct revenue engine. Without compute, there are no tokens. Without tokens, there are no revenues. This framing is absolutely essential because it attempts to justify why capital expenditure from these massive clients just won't suddenly dry up.
To understand this permanent structural shift, Jensen uses this really great, kind of funny analogy. He compares traditional pre-compiled software to a pre-recorded DVD. In the old days, software was written once and run efficiently. But today, generative AI requires continuous, massive compute to generate outcomes contextually in real time. It's a fundamental shift from just retrieving information to actively generating it, and that requires literally orders of magnitude more computing power.
And honestly, this transition is incredibly stark when you look at the financials. Nvidia's revenue has almost entirely shifted away from its legacy graphics business, pivoting heavily toward compute and networking. The market just doesn't view Nvidia as a gaming company anymore. They view it as the world's most critical infrastructure provider for this massive global AI build-out.
Now, if we accept this massive technological shift, we got to look at the specific upside triggers. That brings us to Section 3, the bull case accelerates. Let's analyze all the reasons why Nvidia's stock might continue to climb in 2026, 2027, and 2028.
The bullish upside here is super aggressive and heavily reliant on engineering velocity. In 2026, Nvidia is expected to exceed the $500 billion revenue opportunity brought by their new Blackwell and Vera Rubin architectures. Moving into 2027, Nvidia's CFO confirmed that supply commitments are already extending into that calendar year, with analysts like Pierre Ferragu projecting a massive $1 trillion revenue opportunity. And looking out toward 2028, the whole bull case rests on data center capex scaling toward a staggering $3 to $4 trillion by 2030, all driven by the global deployment of agentic AI.
So, when you factor in those 75% gross margins and their massive free cash flow generation, the upside targets are pretty lofty. Analyst Pierre Ferragu sets a $275 target, noting that earnings could actually exceed $20 per share. Meanwhile, the hyper-bullish market scenario suggests the stock could rocket toward $900. That's a potential $22 trillion market cap, assuming the CEO's ambitions hold steady. With free cash flow projected to hit $80 billion, fueling massive buybacks and dividends, the bull thesis is really built on this incredible cash generation engine.
But hey, to get the full picture, any seasoned storyteller of the markets knows we have to swing the pendulum to the other side. Section 4, the bear market warning. Because the higher the climb, the steeper the potential fall.
We really have to ask the hard questions here. What happens to Nvidia if enterprise adoption of agentic AI stalls out? What if the cost to generate a token drops faster than the demand for tokens actually grows? If hyperscaler spending fatigue sets in, well, that whole idea that compute equals revenues could face a very harsh reality check.
And the competitive evidence is definitely piling up. Think back to our Google comparison for a second. Based on Google's stock volatility over the past 10 years, we know for a fact that competitors eventually adopt, forcing margins to normalize. Google actually launched its own custom TPU chip way back in 2015 and now sells it to third parties. Amazon launched Trainium in 2020, AMD is aggressively pushing its alternatives, plus there is this persistent risk of an open-source alternative to Nvidia software popping up. History tells us that as markets mature, massive 75% margins just naturally compress.
So balancing these massive, multi-trillion-dollar growth projections against some very real structural competitive risks brings us to our final synthesis, Section 5, is Nvidia priced for perfection?
Let's talk intrinsic value. According to the University of Iowa's Krauss Fund discounted cash flow model, which smartly assumes that growth and margins will naturally normalize closer to historical levels as the market matures over the next decade, the intrinsic value sits right around $206.92. Compare that to the current price of roughly $215. This basically suggests that the current stock price perfectly bakes in today's peak economics. It implies that if execution falters even slightly, there is very, very little margin of safety.
So based on the up and down price history of tech behemoths like Google over the past 10 years, you really have to evaluate the potential upside of Nvidia over the next 10 years very carefully. Will the stock defy financial gravity because of this unprecedented shift to agentic AI? Or is it going to mimic the volatility we've seen in other titans, experiencing sharp corrections as spending discipline returns to the hyperscalers and competition chips away at those 75% margins?
It is literally the ultimate debate in modern finance. Finally, please remember that this explainer is strictly for informational purposes. Everyone should do their own detailed research and consult a professional before investing in any company. But as we look at this pivotal moment, we have to ask ourselves, are we witnessing the peak of a hardware bubble, or is this just the opening act of a multi-decade AI revolution? The future is being written right now. Thanks for hanging out with me today.